When you checked the silver price recently, you may have noticed the drop. On Friday, it hit $61.84, a sharp dip that has triggered a lot of chatter among traders, analysts, and news outlets. Many of them want you to believe that the silver rally is over. They want you to think that the squeeze has failed, that the banks and institutions have won once again, and that this entire silver story is simply a game of paper contracts being manipulated by Wall Street. In their view, the price drop means the silver market is back to normal, and nothing extraordinary is happening. But here's the thing. This narrative is misleading, and worse, it's dangerous. What they are not telling you is the story that is playing out behind the scenes. The story of a massive shift in the global economy, a shift driven by one technological breakthrough that will change the silver market forever. This shift is not happening on Wall Street. It's happening in a quiet high-tech lab in Suwon, South Korea. And the catalyst for this change is Samsung. Samsung SDI, the energy division of Samsung that powers electric vehicles, EVs, for major brands like BMW, Stellantis, and Rivian, has announced a battery breakthrough. At first glance, the media coverage seems focused on the typical talking points, 9-minute charging times and a 900-mile range. These are impressive, but they miss one extremely important detail, one that could make a simple supply deficit in silver look like a rounding error. The real story lies in what's inside the battery. Silver is the game changer here, but not in the way you think. It's not just used in tiny amounts for conductivity like in traditional lithium-ion batteries. Samsung's new solid-state battery technology has moved silver from a precious metal to a strategic energy metal. It's a fundamental shift that will create a silver supply crisis the likes of which we've never seen before. Understanding the dendrite problem and how Samsung solves it for over 30 years. Lithium-ion batteries have been used in everything from cell phones to electric vehicles. They've revolutionized how we store and use energy. But lithium-ion technology has a critical limitation: the formation of dendrites. Dendrites are needle-like crystals that form during fast charging, and they can pierce through the battery's separator. When this happens, it causes short circuits, leading to potential fires or even explosions. This has been a major barrier to improving battery charging speeds and efficiency. But now, Samsung has solved this issue. Samsung has used a silver-carbon nanocomposite layer in their new solid-state battery. This composite layer prevents dendrites from forming, ensuring that the battery can charge faster and more safely. The key ingredient here is silver. Silver is lithophilic, which means it chemically bonds with lithium ions, dissolving them as they reach the anode. This spreads the ions evenly and prevents the formation of dendrites. As a result, the battery can charge rapidly and without the fire risk that has plagued lithium-ion technology. It's a breakthrough, a real-world application of silver that will change the future of electric vehicles, energy storage, and renewable energy. For decades, silver has been used in small amounts in various technologies, including electronics, medical devices, solar panels, and more. In lithium-ion batteries, silver was always used as a trace element, just a few micrograms or milligrams per cell. It was enough to facilitate conductivity, but not enough to drive significant demand. But Samsung's breakthrough changes all of that. In the new solid-state battery technology, silver is no longer just a trace element, it is a primary component. To make this battery work at the scale that's required for electric vehicles, Samsung needs grams of silver, not micrograms. This shift is a game-changer for the silver market. Here's the math. Each solid-state battery cell in Samsung's design requires 5 grams of silver. For a standard 100 kilowatt-hours battery pack, the type needed to achieve that 900-mile range, 200 cells are required. So, when you multiply 5 grams by 200 cells, you get 1,000 grams of silver per car. That's 1 kilogram of silver per electric vehicle F battery. To put that in perspective, that's 32.15 troy ounces of silver in every luxury sedan rolling off the production line. 1 kilogram of silver is enough to fill a full tube of Silver Eagles, plus another half tube. If you're not familiar with silver coins, a tube of Silver Eagles contains 20 ounces of silver, which means there is more than 32 ounces of silver in just one car's battery. Now, let's scale this up to a global level. The auto industry produces roughly 80 million cars every year. Even if we assume that only 20% of these vehicles will use Samsung's solid-state battery by 2028, we're talking about 16 million cars. And if each of those cars uses 1 kilogram of silver, that's an additional 16,000 metric tons of silver needed each year. Remember, the total global silver mine supply is only about 26,000 tons per year. So this single new demand from the automotive industry could easily consume 60% of the world's silver supply. And that's just for electric vehicles. It doesn't even take into account the growing demand from solar panels, electronics, and other industries that are already battling for an ever-shrinking silver supply. This is where things get serious. The demand for silver is about to explode, but the supply is already stretched thin. Mining silver isn't as easy as pressing a button. It takes years of exploration, permits, and investment to bring new mines online. And the silver that's left in the Earth's crust is increasingly harder to access. We are running out of easy-to-mine silver. The silver that remains is more expensive to extract, and mining companies are already dealing with diminishing returns. In 2005, a high-grade silver mine would yield 15 ounces of silver per ton of rock. Today, that number has collapsed to just 4 ounces per ton. It's not just a slight drop, it's a massive decline. Mining companies now have to dig up 4 times as much rock to extract the same amount of silver. That means the cost of production is skyrocketing. But the demand is also rising at an exponential rate. This is a classic supply-demand crisis. On one hand, you have the soaring demand from industries like electric vehicles and solar panels. On the other hand, you have a shrinking supply of silver. And because it takes 10 to 15 years to bring new silver mines online, there is no quick fix for this crisis. The price of silver will have to rise to reflect the true cost of production and to ration the limited supply. The drop in the paper price of silver to $61.84 is nothing more than a temporary illusion, driven by market algorithms and short-term panic. The real story is much more exciting and significant. Samsung's new solid-state battery has introduced a new demand for silver, a demand that is immediate, massive, and unsustainable. The combination of a shrinking supply and a growing demand from electric vehicles, solar panels, and electronics is setting the stage for a silver crisis that will force prices to rise. And as the world moves towards renewable energy, silver is about to become one of the most critical and valuable resources on the planet. The geological wall and the supply crisis, as we discussed in Part 1, the silver market is undergoing a massive shift, a shift that most traders and analysts still don't fully understand. Samsung's solid-state battery breakthrough, using silver as a key component, is about to drive unprecedented demand for silver, with the potential to consume over 60% of the world's silver supply. But the true magnitude of this shift can only be fully appreciated when we consider the geological and supply-side constraints that are now stacking the odds against the silver market. To put it simply, we are running out of easy-to-access silver. The world's silver mines are yielding less and less silver for every ton of rock that's dug up. In 2005, the average high-grade silver mine would produce about 15 ounces of silver for every ton of rock that was processed. Today, that figure has collapsed to just 4 ounces per ton. This significant decline in silver yields is a direct result of diminishing returns in the mining industry. In other words, miners are now having to dig up 4 times as much rock to extract the same amount of silver. This means that the cost of production is rising rapidly, but silver is still priced relatively low, at least for now. The consequences of this geological wall are serious. As the amount of silver extracted per ton of ore continues to decline, the cost to mine becomes more expensive. The profit margins from miners shrink. New, high-grade deposits of silver are becoming harder to find, and the best, most accessible deposits have already been tapped. The easy silver is gone, and what remains is far more expensive to produce. There's another major problem that the market faces: the time lag in bringing new silver mines online. On paper, the price of silver could rise quickly to balance supply and demand. But in reality, it's not that simple. The process of discovering a new silver deposit, securing the rights to mine it, obtaining the necessary permits, and building the infrastructure to actually mine the silver takes a decade or more. In fact, it takes about 10 to 15 years from the time a new silver deposit is discovered to when that silver actually reaches the market. That's because the process of mining is not instantaneous. Exploration alone can take years, and the process of extracting silver requires drilling, blasting, refining, and often dealing with complicated environmental regulations. A geologist could find a rich vein of silver today, but that silver won't reach the market until the 2040s. This time lag creates a severe mismatch between demand and supply. Samsung, for instance, needs silver now for its solid-state batteries, which will power the next generation of electric vehicles. But new silver production won't be available until many years from now. So, as demand surges due to the adoption of electric vehicles and other technologies, the supply of silver will remain frozen in place, unable to catch up with the growing need for it. In addition to the geological challenges, there are significant geopolitical issues that further restrict the silver supply. Silver is produced in only a handful of countries, and these countries are facing increasing pressure that limits the ability to extract and export silver. The largest producer of silver in the world is Mexico, accounting for nearly 25% of global supply. However, Mexico's government has effectively halted the issuance of new mining permits, making it more difficult for companies to expand silver production. The Mexican government's stance is likely to make it harder to ramp up silver output at a time when demand is soaring. In fact, Peru, the second largest silver producer, is facing its own set of challenges. The country is plagued by labor strikes, community blockades, and social unrest, which have disrupted mining operations and made it even harder for miners to produce silver. Russia, another major silver producer, is dealing with international sanctions and other political issues that have reduced its silver output. These challenges have created a perfect storm of supply-side constraints in silver production, making it even harder to meet the growing demand driven by electric vehicles and other industries. The shrinking silver mining industry. On top of these political and geological barriers, the silver mining industry itself is in a state of decline. The number of large, high-grade silver mines is shrinking, and those that remain are facing increasingly high production costs. In recent years, mining companies have been forced to dig deeper, use more expensive methods, and waste more energy just to maintain their output. As a result, the profitability of silver mining is shrinking, and fewer companies are willing to invest in new silver exploration projects. In 2005, silver mining was relatively lucrative, with many mines operating at high profitability. But as silver deposits have become harder to access, miners have been forced to rely on less efficient and more expensive mining techniques. This has driven up the cost of silver production, and it's likely that we will continue to see these costs increase as the best deposits continue to dry up. This shrinking supply of easily accessible silver is a major factor in the coming silver shortage. As new silver production becomes increasingly expensive, the industry is ill-prepared to meet the soaring demand for silver, driven largely by the rise of electric vehicles and renewable energy. The combination of these challenges will push silver prices higher and higher as the market moves from a position of deficit to crisis. It's important to understand that we are facing a silver supply crisis like nothing we've ever seen before. This crisis is not just about rising demand or political instability. It's about a perfect storm of geological, political, and economic factors that are pushing silver towards a supply cliff. The most immediate source of demand is the electric vehicle market, which is expected to grow rapidly in the coming years. As automakers shift towards solid-state batteries, the demand for silver will skyrocket. Samsung's breakthrough in solid-state batteries is just the beginning. As more companies adopt this technology, the pressure on the silver market will only increase. Tesla, Ford, General Motors, and other major manufacturers will all need more and more silver for their vehicles. At the same time, the solar panel industry, electronics, and medical devices will continue to compete for silver. Solar panels alone already consume about 15% of the global silver supply. And with the continued push for renewable energy, this demand is set to increase. But the real kicker is that the silver supply simply cannot keep up with this surge in demand. The global mine supply is already too small to meet the growing demand from the automotive and renewable energy sectors. This is why the silver price is on the verge of exploding. So, what happens next? With the geological limitations, the supply-side constraints, and the explosive demand from electric vehicles and renewable energy, the silver market is on the edge of a dramatic shift. The price of silver, which has been relatively low for decades, will have to adjust. The current price of $61.84 may seem high for a commodity that's been hovering around $20 to $30 per ounce for years, but this price is still far too low to account for the true supply-demand imbalance. The only way to resolve this crisis is through higher prices. The price of silver must rise to levels that will encourage more mining and better utilization of the limited supply. The increase in price will also be necessary to ration the silver that remains in the market. As the price rises, it will attract more mining activity, but the supply response will still be slow because of the time lag in mining operations. But even as silver prices rise, the structural supply deficit will likely persist. We may reach a point where silver is so scarce that it becomes unobtainable for most industries. We are looking at a situation where only the highest bidders will be able to secure the silver they need, leaving smaller industries and retail investors out in the cold. The geological and geopolitical barriers to silver supply are creating a perfect storm that will push silver prices to unprecedented levels. The combination of declining silver yields, mining challenges, and the explosive demand from industries like electric vehicles and solar panels is creating a crisis that will only worsen in the coming years. The silver market is facing an inescapable supply crunch, and the price of silver will have to rise dramatically to meet the demand. The role of geopolitical forces and how this all translates into massive wealth opportunities for those who understand the shift happening in the silver market. The silver market is on the brink of a monumental shift. The demand for silver is about to skyrocket, driven by new technologies like Samsung's solid-state battery, which uses silver as a key component. However, this demand comes at a time when global silver supplies are already under severe strain. We will explore the arbitrage opportunities that are emerging due to the price discrepancies between paper silver and physical silver, the geopolitical and financial implications of these shifts, and the wealth-building potential for those who understand the evolving dynamics of the silver market. A crucial aspect of the silver market crisis is the divergence between the paper price of silver, which is primarily influenced by futures contracts and financial trading, and the physical price of silver, which is determined by the actual supply and demand in the real world. This gap is creating a powerful arbitrage opportunity, a situation where silver can be bought at one price in the paper market and sold at a higher price in the physical market. Here's how this works. On Friday, the price of silver in New York COMEX dropped to $61.84. But on the other side of the world, in Shanghai, the price of silver was much higher. In Shanghai, the physical silver price was trading at a premium of $5 to $7 higher than the price in New York. This represents a massive arbitrage gap, which is a signal that the paper market and the physical market are no longer aligned. Why does this gap exist? The answer lies in market mechanics. In the paper silver market, the price is determined by futures contracts and speculative trading. These contracts are based on paper promises to deliver silver at a future date. But in the physical silver market, the price is determined by the actual supply and demand for silver. With growing industrial demand from electric vehicles, solar panels, and electronics, the physical market is under intense pressure, and the price in the physical market reflects that pressure. The key takeaway here is that smart money, including global macro funds and industrial traders, can exploit this arbitrage gap. They can buy silver contracts in New York at the lower price, take physical delivery, and then sell it in Shanghai at a higher price, pocketing a risk-free profit. This is a self-correcting mechanism that pulls physical silver out of the Western vaults and moves it to the strategic reserves in the East. Why the price gap is a sign of a broken market. The arbitrage gap between the paper price and the physical price is a clear indicator that something is wrong in the silver market. In a well-functioning market, this gap would be narrow. But in the current environment, the gap has widened dramatically, indicating that the silver market is broken. The issue is simple. Paper silver is being traded based on inflation data, interest rates, and macroeconomic factors, but it doesn't reflect the actual supply and demand for silver in the real world. The physical price of silver, on the other hand, is driven by the real-world use of silver in industries like electric vehicles and renewable energy. The result is a massive disconnect between the two prices. When there's a disconnect like this, it creates an arbitrage opportunity. Smart money sees that they can buy cheap silver contracts in New York and sell the physical metal in Shanghai for a higher price. This process has been draining the physical silver supply from the West and moving it to the East, where countries like China and South Korea are stockpiling silver for use in battery production and other critical industries. The consequence of this arbitrage is clear. The physical silver supply in the West is running out. The silver that was once stored in the COMEX vaults and other Western storage facilities is being shipped overseas, where it is being used in critical technologies like Samsung's solid-state batteries. As this supply is drained, the price of silver in the physical market will increase rapidly, while the paper market will continue to lag behind. The divergence between the paper and physical silver prices is not just a market anomaly. It is a signal that a sovereign squeeze is coming. The term sovereign squeeze refers to a situation where governments and strategic industries move to secure critical resources, in this case, silver, to ensure that their national interests are met. In the current environment, the geopolitical stakes surrounding silver are incredibly high. Countries like China and South Korea are making massive investments in electric vehicle production and battery technology, and they understand that silver is a strategic asset that will power the future of energy storage. Samsung, the South Korean tech giant, is already hoarding silver to meet the demand for its new solid-state batteries, and other nations are likely to follow suit. As the global transition to electric vehicles and renewable energy accelerates, governments will take drastic steps to secure their access to silver. We've seen this before with other critical resources. In 1933, President Franklin D. Roosevelt signed Executive Order 6102, which effectively criminalized the possession of gold in the U.S. during the Great Depression. The government seized gold from private citizens to recapitalize the banking system and stabilize the economy. In the future, governments could take similar actions to seize silver. The Defense Production Act could be invoked, just like it was during wartime, to prioritize silver for strategic industries like electric vehicles, energy storage, and military technology. The U.S. government, for example, could decide to nationalize silver to ensure that the metal is directed toward the battery manufacturers and energy sectors that are critical to the country's economic and defense needs. This is the nightmare scenario for retail investors who hold physical silver. Once the sovereign squeeze begins, the private market could be locked out of the silver market entirely, with governments and corporations hoarding the remaining supply. Silver may become unobtainable for individual investors, and prices could rise to levels that most people can't afford. While the paper silver market is largely speculative, the real price discovery for silver will take place in the mining industry. As the supply crisis deepens, miners will become the gatekeepers of silver, controlling the flow of metal into the market. But even here, there's a critical caveat: the majority of silver mining companies are hedged. Hedging occurs when mining companies enter into forward sales contracts, locking in a price for their future production. This is done to reduce risk and ensure stable cash flow. But the problem with hedging is that it limits the upside potential for miners. If silver prices rise dramatically, as we expect they will, the miners who are hedged will be stuck selling their silver at lower prices, while the rest of the market benefits from the higher prices. This is a huge opportunity for investors who understand the dynamics of the silver market. Unhedged miners, or those who haven't locked in prices for their future production, will be the biggest beneficiaries of the silver price rise. These companies will see their profit margins explode as silver prices surge. As silver prices increase, their profit margins will skyrocket, allowing them to capture all the upside from the supply crisis. For those who understand what's happening in the silver market, this is a once-in-a-lifetime wealth-building opportunity. The price of silver is poised to explode, and those who are positioned correctly could see massive returns on their investments. But there's one catch: you need to be strategic about how you approach the market. The first step is to focus on physical silver. This is the most direct way to benefit from the supply crisis. Silver bullion, whether in the form of coins or bars, will become increasingly valuable as the crisis unfolds. It's important to focus on low-premium silver products, such as 100-ounce bars or government-issued coins, which are the most cost-effective way to accumulate silver. Next, if you're considering investing in silver mining stocks, be sure to avoid hedged companies. Companies that have locked in prices for their future production will not benefit as much from the silver price rise. Instead, look for unhedged miners that are positioned to capitalize on the coming price surge. These companies will experience massive increases in profitability, and their stock prices will reflect that. Finally, keep an eye on geopolitical developments. As we move closer to a sovereign squeeze, it's likely that silver will become a government-controlled resource. This could push the price of silver to unsustainable levels, but it will also lock retail investors out of the market. Accumulate silver now while it's still available, and be ready to adjust your strategy as the situation unfolds. The silver market is about to undergo a historic transformation, driven by the convergence of demand from emerging technologies and supply constraints that are more severe than most people realize. The current paper price of silver is illusory, masking the real-world supply crisis that is unfolding before us. As the demand for silver soars, the price will have to rise to meet it. And this will create an unprecedented wealth-building opportunity for those who understand what's happening. In the coming months and years, we will see massive price increases, driven by the demand from electric vehicles, solar panels, and other industries that rely on silver. But the real silver story is happening in the physical market, where supply is running out and prices will have to adjust violently. If you are positioned correctly, you could stand to make life-changing gains. But time is running out. The sovereign squeeze is coming, and when it does, silver will become a critical resource in the fight for energy and industrial dominance. Prepare now, before it's too late, and get ready to take advantage of the biggest shift in the silver market in decades.